little bit of cash, $400. You can see we don't have any oil trade on. The euro is losing just 50 bucks. It's offset by a larger position on the copper and a smaller position on the bond. And you can see that the overall position has a profit of $700, $800 minus $500. That's a net profit and loss. A net profit and loss of 300. Pretty obvious stuff. Pretty easy stuff, obviously, in terms of those macros. And we could obviously potentially close off our copper position and our gold position, make approximately $200, and that would leave us with a $300 profit on the bond, which we could close off against the euro, which would leave us with a net short bond position with no risk whatsoever to maybe make some extra money. So that's how you go about looking at that as a process. And if that's what you're trying to do, of course, then obviously your job now is to try and manage out those positions. Now we're in profit on the euro as well as the bond. We've got $400. We're up about $700 now on the trade. So we will do that bit of business. I'll try and do a bit of business to close off the gold position. And we'll get ready to buy the copper position back as well. Just ran away from us just a little bit there. We're trying to bid some 17s for the bond. And we've completed the vast majority of that spread now. Not for a lot of money, but we're still doing okay. We're doing not too bad. We've made, I'll close the bond off, which I'll just do just now. Close the bond off just now. And that'll give us a 0 point. So we'll show you what we did in terms of that outcome. So that spread we've just done and completed there, we've went from a total gross realized profit of $4,200 to $4,800. So we made about $600 in total. Realized profits, you can see we've closed off all the positions now to bring our unrealized position back to 0. And we've went from $4,200 to $4,800, $600 more on the spread, $600 more in that last little spread. That's okay. That'll do us. That'll keep us happy for the time being, won't it? So we'll hopefully be over $5,000 by 4 o'clock today. That's where hopefully we'll get to. I'm looking at gold against the dollar as a straightforward spread, so I'm going to be looking at that one. So we'll pop a little position in this one. Okay, that spread's up $70 at the moment. Little spread that's up 70 bucks. And that's all because of the gold position. We sold some black line up here. We bought the black line at the top edge here, and we did some red line on the downtick. We're now up $190 on that position. $200, $230. No movement yet on the euro. It's $270. I wanted to try and get over 5,000 before we got started in Classroom, so I did 3 spreads on that one, and I've taken it over 5,000. Okay, so that was pretty easy. So we did a gold euro trade, and as I said, I wanted to desperately to get over 5,000. No, for no reason except I always like wee challenges like that. So there it is. There, we took 3 spreads on gold and the euro, 3 spreads on gold, 3 spreads on the euro, and we went from $4,800 to $5,100, and we've achieved our target 5,000 before 4 o'clock. So that was pretty good. Nice way to finish off. Nice way to finish off today's spreads. The gold is 1 over gold, just simply 1 over gold, Sam. So we're buying or selling gold itself, yeah. So you can see that this project started at 0. We opened the book at 0. We did the first spread trade, which was this one here. We then did a big spread trade. We got up to 10 spreads on this one, 10 spreads on the final middle trade. And obviously that was pretty good. And we managed to make a lot of money on 10 spreads. A lot of that was obviously going back to that oil movement as well. We managed to increase it from 3,000 to 3,400, and then from 3,400 to 4,002, from 4.2 to 5.48, and from 4.8 to 5.1. Spread trades, spread trades, spread trades, spread trades, spread trades on the market story, guys. Spread trades on the market story. Yeah, because the real yield is what we want to know about the dollar, don't we? We're trying to understand what the dollar is going to do with the real yields, and because we've got 2 real yields, we can understand the difference between the 2 real yields, giving us some ideas about possible trades on the commodities, aren't we? This wasn't meant to be a spread chart; it was meant to be an information chart, but we just decided to use it for spreading purposes so that you guys could understand a little bit of the logic behind the spreads themselves. So we can see as real yields have been falling, the idea of the dollar being at higher prices seems to be a little bit dubious, to say the least. So the probability is that the dollar is going to find it difficult going any higher beyond those highs, and that's going to allow you to start thinking about the fact that the dollar sellers may start putting bids into these very, very cheap-looking gold products. And therefore, buying gold against a falling real yield like this is either going to be what? It's either going to be bonds or it's going to be oil, right? It's either going to be bonds or oil. And, you're obviously going to be able to look at that as a spread. Now, if it's oil, of course, what you would be doing is if you're buying the orange line, you'd be selling oil into that storyline. You'd be looking at that from that perspective, but that's obviously not what we're looking at. We're looking really at the dollar-gold relationship just now, and that's a very straightforward relationship. Could you trade oil shorts against gold longs? Yeah, you could. Of course you could. You've got to realize that the gold-oil relationship can be very, very temperamental. It's one of probably the widest relationships you can have because you're really 2 different asset classes that don't have any real bearing on each other. So if you ever end up with an oil-gold relationship, you really are playing in the Wild West of spread trades. The correlation between gold and oil, of course, is pretty remote at times. The good thing is that you've got the abilities, because you know how to work correlation coefficients, you've got the ability to calculate what the R squared is on all of these markets. You could look at the gold R squared against the dollar, the gold R squared against the gold R squared against copper, and the gold R squared against oil, and you can see which ones are tight at 1.0 or minus 1.0, and which ones are sitting around about the 0 point, which makes life very, very difficult, of course, because obviously the spread can be very wide. There is no natural relationship. And as a result, you can obviously understand that that could cause you serious spread widenings that you've got to contend with as you go forward. But we've had a good day on spreads so far. We did what we said we would do yesterday. We've aggressively traded some of these. I was hoping that we would get a few more people giving a couple of shouts. But it is what it is. Perhaps you've taken part, perhaps you haven't. But if you understand it, you'll get something from it. You'll get something from it. Well, that's right, Paul. I mean, it's about the process. It's not about these markets. It's about understanding the process. If you want to trade 5s, 10s, and 30-year bonds with the ultras, it tells you the process that you use. You try and trade these with value. You maybe buy some 5s and sell some 30s. You're starting to trade a steepener in the FOB spread, aren't you? You're starting to trade particularly a steepener in the FOB spread, and as a result, you're looking at the oil price going up, and you're saying that's the trade I want. I want that FOB spread steepener. I want to be involved in that trade. So you start trading the 5s, 30s. If you want to trade oil against RBOB, you basically end up trading the crack spread, right? If you want to trade gold against silver, you're trading the precious metal spread, or gold against platinum, or platinum, gold, and silver. You're trading a precious metals complex. If you want to trade the NASDAQ against the Russell, against the S&P, you're trading an equity complex. If you want to trade the bonds against the bunds against the gilts, then you're trading a treasury complex. You're trading a global treasury complex, which you could offset against the pound against the dollar, for example, the euro against the dollar, or the yen against the dollar, if you're going to go into the GGBs. Then, of course, that's what we start thinking about. We start saying, okay, well, that makes perfect sense. I'm going to trade the bonds and the gilts against whatever the pound dollar's doing, or against whatever the euro dollar's doing, or whatever else you're thinking. And obviously you can offset that by a 6E or 6B hedge trade as well. And that's brilliant, isn't it? That really does give us something we can work around as a spread. Now, what happens is you end up being effectively exactly the same as what the bank desks do. They're trading the carry against the Forex markets. And when you trade the carry against the Forex markets, that's what the banks do. You're doing the same trades as the bank desk traders are doing every single day of the week.